of you have heard of this term and know what it is, but for those of you who are hearing this word for the first time, Nexus is a situation in which a business has presence in a particular state. In other words, Nexus is a connection between a state, aka the taxing authority, and an entity that must collect or pay tax. To simplify it even further, it means you have sufficient physical presence or economic activity within a state. Now, there are many ways for Nexus to be created, and each state has different rules. There are a few Nexus definitions that most states would more or less agree with. And I'm going to quote this directly from some of their statutes, and I'm going to actually see if I can paste this in our chat so you guys can see it as well, because it's a lot of verbiage and lots of commas and all that fun stuff. So I just added it, so read along with me because it's going to be fun. So the first Nexus definition is maintaining, occupying, or using permanently or temporarily, directly or indirectly, or through a subsidiary, an office, place of distribution, sales or sample room or place, warehouse or storage place, or other place of business. Geez, that's a mouthful. But to put this in simple terms, it's saying that you either own or rent a building in a state, which then creates physical nexus. So the next definition for nexus that most states can kind of agree with is having a representative, agent, salesman, canvasser, or solicitor operating in the state under the authority of the retailer or its subsidiary on a temporary or permanent basis. So I think that one's a little bit more clear, but just to put it in plain English, if you have a representative handling business in a state, you will most likely have nexus there. So the next definition is probably one we are all familiar with due to Wayfair. It's been populating around the world, I guess the United States, for the past year and a half. So this definition states that any seller which does not have physical presence in this state shall remit sales or use tax if the seller meets either 1, gross sales from the sale of taxable items delivered in this state that exceed $100,000, or 2, the seller sold taxable items for delivery in this state in 200 or more separate transactions. So this definition changed the ballgame in regards to nexus. It created what we now know as economic nexus, where you don't necessarily need to have physical presence in order to have states come knocking on your door. So moving forward, if I can get this slide to work, there we go. So now we're back to working remotely. So how are your employees generating nexus? Well, many states claim that an employee working from home within those states gives the employer nexus for tax purposes, even if the employer does not own or lease a building or have property in that state. So, however, if an employee is working remote, you are most likely going to have property in that state. Many employees use company laptops in order to do their work, and they're most likely taking that laptop with them to the new state that decided to work in. And so then what do you have now? You have property in a company that you have company property in a state that you were never affiliated with. So there's another instance of physical nexus. So now that I've told you a little bit about nexus and how working from home can create it, I bet you're wondering how this can affect employers.
And the 2019 return, I've never used this language before.
All right, Keith, can you mute? Thank you. Happens. All right, so now that we've talked about nexus and how we can create it by working from home, we're going to figure out how this affects our employers. So if you have a client with employees working in other states, you might have additional filing requirements. If a business has nexus with the state, the business may be obligated to pay that state's franchise, income, or other business tax, to collect and remit sales or use tax on taxable sales that the business made into the state, to remit payroll taxes to the state, and to comply with other tax payment or reporting requirements in that state. So before you start paying, collecting, or remitting taxes, you will need to register to do business. Once you have done that, you will most likely have to register your employee with the state and file various forms in order to start withholding income tax from their paychecks. Generally, states impose a personal income tax, require companies to withhold income tax from an employee's wages for wages earned within that state. So in order for an employer to be required to file an income tax with a new state, they must have Nexus, which, as we know, it's being created by having an employee working in that state. Before the pandemic, states usually had a clear-cut guideline based on the number of days presence within that state before physical presence could be established for Nexus purposes. I guess for many states, once you've been physically present in that state for more than, I guess, 7 to 10 days, the Nexus is going to be created and a filing requirement required. And if you had employees working around 7 to 10 days or less, then you're fine. You wouldn't have a filing requirement. So moving on to yet another filing requirement that could be generated from an employee working in another state is sales tax. So depending on what you're selling in the state, you may or may not need to collect sales tax. Generally, services are not taxable, but if the service that is provided includes creating or manufacturing a product, you may have a sales tax requirement. If a company is selling tangible goods within a state, they will most likely have to collect taxes on items sold. Of course, there are always exceptions that would exclude you from having to collect sales tax on tangible goods sold, but that's for another day. I don't want to get into that today. So before we start looking at the state guidance post-pandemic, let's take a look at a few examples of how some states were handling remote workers before this pandemic happened. So here's our first example. The taxpayer had moved out of Oklahoma in August of 2010 and filed as a non-resident for the 2010 tax year. He has been working remotely out of state since 2010, performing no services in Oklahoma. Taxpayer is now a resident of another state where he files and pays income tax. His employer, an Oklahoma resident entity, continues to withhold Oklahoma income tax from his paycheck. So it looks like we have an employee who has been working remotely from some other state for an employer based in Oklahoma. So in a letter ruling sent to an employer from the Oklahoma Tax Policy Division, they stated that as a non-resident whose salaries, wages, and commissions are for work performed outside of Oklahoma, and who derives no income from sources within the state of Oklahoma, the employer is not required to deduct and withhold Oklahoma withholding taxes from his wages. I have another example here as well, so bear with me. The taxpayer is an employee of a small private civil engineering consulting company located in Illinois. Employer is a resident Illinois entity paying income tax in that state. In 2013, the taxpayer's employer allowed him to move and reside permanently in another state while continuing to work for the Illinois employer as a satellite employee. The taxpayer said that the vast majority of his work was performed from his home office in another state. However, he occasionally went into Illinois to meet with clients and inspect infrastructure improvements. So in response to some questions that Illinois sent a notice to him, asked him a few questions, the taxpayer stated that he did not meet any of the localization tests that are used to determine compensation in Illinois. None of the taxpayer's services were provided in Illinois. The services he provided while in Illinois were actually incidental to services provided to his state. And finally, he had established a base of operations with his home office in his resident state, while Illinois currently has reciprocal agreements with Iowa, Kentucky, Michigan, or Wisconsin. They do not have reciprocal agreements with the state where the taxpayer resides. So the state came back with a general information letter, and they said that based on the employee's stated fact pattern, the taxpayer had a permanent job location in another state, so a state other than Illinois, which he had described as a home office. Based on that description, the permanent job location is the base of operations, and none of the wages paid to the taxpayer would be paid to the state of Illinois. So accordingly, none of the wages paid to the taxpayer would be subject to Illinois income tax withholding. So in both of these examples, the outcome resulted with the employer having to withhold income taxes in the state in which the taxpayers resided, not Oklahoma or Illinois. So moving on, fast forward to today, and we have a little bit of state guidance on how some of these states are reacting to employees working remotely in states other than their resident state. So as you can see from the states listed on the slide, we have a good number of states who have come out and said they're waiving Nexus for business with remote employees during the pandemic or active stay-at-home order. So yay, woohoo! But we can't take what they say at face value. We need to look at the terminology used by the states and that's kind of where some of the mystery still lies. For example, for Minnesota, their terminology is similar to most states, so I'm going to use that as an example. Their guidance states that Minnesota will not impose Nexus for business income tax solely because an employee is temporarily working from home due to the COVID-19 pandemic. But we don't know what their definition of temporary is. Does temporary mean just a few weeks, or does it encompass the full 9 months that we've been dealing with this pandemic? So I think until we get more guidance from the states, I don't think we can definitively say that a company won't have Nexus in these states. Another thing to think about is whether your company or client's companies plan to embrace the work from home model and keep doing business as they have been during these past 9 months. If teleworking becomes a permanent part of the company, then the Nexus waivers previously mentioned, they're not going to work. They're not going to provide the protection for the company. And yet another thing that needs to be considered is whether your state has reciprocal agreements with other states. If an employee had principally worked in a state other than their home state, but is working from their home state due to the pandemic, there's no change to withholding from employment income if these states have reciprocal agreements. So if we look at Virginia, they have reciprocal agreements with DC, Kentucky, Maryland, Pennsylvania, and West Virginia. So if any of your employees had gone to any of these other states outside of Virginia, then you're good. You don't really have to worry about much. And like one of the funny things I found when I was kind of looking at reciprocal agreements, I stopped on Arizona, and Arizona has a reciprocal agreement with Virginia, which is nowhere near them. So I just thought that was odd. Okay, yet another thing that we should be aware of when we're reviewing employees working remotely is to see if they're statutory resident. If a taxpayer maintains a permanent place of abode in a state and spends more than 183 days there, the state's going to treat them as a resident for income tax purposes, regardless of where they're domiciled. And I think David did a really good job explaining this concept earlier, so if no one has any additional questions about being a statutory resident, we can move on. Okay, so worst case scenario, if a state currently does not provide guidance on Nexus created by remote workers, I think it's safe to assume that their Nexus standards are going to remain unchanged during this crazy, crazy time. In fact, Maryland has actually come out and said that there won't be a Nexus waiver for employees working remotely, and that they do not intend to change or alter the facts and circumstances it has consistently used to determine Nexus or income sourcing. So beware of Maryland and any other states that follow their lead. And currently right now, I don't know of any other states that have done that. So on this next slide, you'll see a map of the United States highlighted in various colors. It shows you the level of friendliness of each state when it comes to remote workers and their employees. So if we're looking at this map, the dark teal is the friendliest, and as you can see, it's the least amount of states, of course. So these dark teal states, they allow employees to work a full 30 days or more in a new state before an employer is subject to withholding. So yeah, that's pretty nice. And if we look at the dark magenta color, which seems to be taking over most of the states, once again, of course, that's the case, it means these states are the least friendly. So it looks like we have lots of mean states out there. These darker states require employers to begin withholding on the first day that the employee works in a new state. So Yeah, that's not a good thing. If your employee hasn't told you that they began working in a new state and now you have to file there, they've been working there for a day or more, so I'm sure there'll be penalties associated with that. And then the two colors that fall between the dark teal and the dark magenta, they're between the two extremes of friendliness, so I think we can kind of gloss over that. So moving forward, speaking of penalties, I have a penalty slide. So to keep this short and sweet, if you fail to report employees, withhold or file in these states that an employee has created Nexus, there will be penalties. These vary from state to state, but they should be avoided at all costs. So what should employers do in order to avoid penalties and non-compliance? Well, find out where your employees are working. You can do this by sending out surveys or using the IP address used to connect to the company system, or better yet, just talk to them. It's probably the easiest thing to do. And while you're at it, see how long they plan on working remotely. If it's temporary, Nexus may be waived, but if it's going to be permanent, there's a lot more filing that's going to need to be done. A few additional items that should be considered and that employers should be made aware of is, this was an odd one that I found out there that I had no clue about, so thank goodness for this presentation, is that if a remote worker is in a jurisdiction with higher minimum wage, you're actually required to pay them that higher minimum wage. So that was new to me. So I'm sure it's new to a lot of you guys out there. And then last but not least, this is with the pandemic causing all these budget problems with states. They need some revenue coming their way. So guess what they're doing? They're stepping up their Wayfair enforcement game. And so don't be surprised when your clients or you yourself start getting Nexus questionnaires and the states come knocking on your door. It's coming, so be ready. We've been warning you for about, what, 2 years now? So it's finally here because those states want that money. And remember that Wayfair may be the latest hotness, according to quote David Harris, but Public Law 86-272 is still relevant when it comes to evaluating income tax nexus. So if 86-272 applies, you don't have income nexus, which is great. So before we move on to our next slide, I kind of just want to reach out to see if any of you guys listening in for the past 20 minutes have had any questions from clients related to employees working remotely in other states. And if so, do you care to share what you might have discussed and learned from these conversations? And if not, I can move on to some fun multiple choice questions I have. And I think you guys are really going to appreciate this. It's going to give you a nice little mental breather. So if you have something you want to share, go ahead and raise your hand and let us know. And if not, I will keep on moving. So I don't see any hands. So I think you guys want to do these fun multiple choice questions. So onward. So if you guys could please use the chat function and put in your answer, that would be awesome. So first question, in what state do residents dress up as elves and get together in order to break the record for the most elves in one place? Is it A, Arizona, B, Alabama, C, Texas, or D, Hawaii? Go ahead and use that chat function. All right, looks like we've got a couple answers finally rolling in. All right, I'm gonna move it forward, and guess what? It is Alabama. So for all of you who guessed, what was that? What letter was that? Letter D. Whoever got D, you guys are the winners. Oh, did I? Oh gosh, no. Hold on, don't look. No, I just gave away all my answers. I thought I was going backwards. Oops. It's always something. Okay, from current slide. So now that I've given away my answers, it's fine. Everything's fine. So next question, in what state do people follow the trail of holiday lights from one end of the state to the other? Is it A, Delaware, B, Hawaii, C, Kansas, or D, Arkansas? And you guys might have already seen the answer. And winner is Arkansas. I think that was D. So you got everybody who guessed D, woohoo! Next question. In what state do children leave out milk for the mischievous Tomty spirits on Christmas Eve? Is it A, Montana, B, Utah, C, Delaware, or D, Florida? And as you can see in the picture, those are the mischievous little Tomty spirits. I'm not sure if I'm pronouncing that correct. All right, so winner is Delaware. Next, in what state is fruitcake soaked in whiskey a traditional Christmas dessert? Is it A, Tennessee, B, Maine, C, Oregon, or D, Kentucky? I don't think I'd enjoy that dessert very much. That doesn't sound good to me. All right. Let these answers roll in, and let's see what we got. It is Kentucky. Okay, I think this is our last one before Mark comes up. In what state is the house from A Christmas Story located? Is it A, Virginia, B, Pennsylvania, C, Ohio, D, Vermont? Oh, it looks like we have like a general consensus with C. And C was Ohio, so yeah, you guys know your stuff. Oh, we have another code word, so if you guys just go ahead and open up those surveys again, your second code word is pepper. P-E-P-P-E-R, pepper. So first one was salt, second is pepper. So as you can see, we got a theme going on here. And I think we have Mark next. Yep, that is his slide. So I'm gonna go ahead and release control and you're gonna pick it up and hopefully we have no issues on our end. All right, Mark, it's all yours now. You find that slide and keep on rolling with it. And as we wait for Mark to pull up slides, do you guys know of any other funny state holiday traditions?
So my slides are not appearing at the bottom, Amber. So if you wanted to.
Do you want me to roll again?
Yes.
Okay, let's keep things simple. Screen 2. All right, are you seeing what I'm seeing?
Awesome.
All right, perfect. You just
cool. Can you hear me?
Sure can.
Awesome. Well, great presentation, Amber. That was awesome. So I see a lot of people had fun with those Christmas trivia questions. Highlight outside of David and Helene and all the other participants. It was great stuff.
Yeah, you gotta bring some fun to taxes.
Totally. I agree. So now I would like to transition to another hot topic of discussion, and that is State Conformity CARES Act provisions. So what is the CARES Act? You know, the Coronavirus Aid, Relief, and Economic Securities Act, it was designed to provide economic relief to both businesses and individuals that have been affected by the pandemic. You know, the act was enacted on March 27, 2020, and it contains significant changes to the TCJA Act. And it also has an overwhelming amount of modifications to the Internal Revenue Code and state and local income tax calculations that are based on federal taxable income. Next slide. So today, I'll be discussing the major tax provisions contained within the CARES Act, which includes changes to the business interest expense deduction limitation, the NOL modification, the reclassification of qualified improvement property, and PPP loan forgiveness. Although the CARES Act was designed to alleviate, the financial strains of the pandemic, these provisions present state conformity challenges. And now the question is whether and how states conform to the federal provisions. Next slide. State conformity will be key in determining whether states will adhere to the provisions of the CARE Act. And when it comes to conformity, there are a number of methods that the states use to conform to the IRC. So the first one is the rolling or move-in date conformity. The second is the static or fixed date conformity. And the last one is the selective conformity. States with rolling conformity automatically implement federal changes as they are enacted, unless the state decouples from a provision. States with static conformity implements federal tax changes at a specific point in time rather than adopting all the changes on a rolling basis. And states with selective conformity adopt only certain IRC provisions as of a specified date or make changes to key provisions. There are 21 states that have rolling conformity, 21 states that have fixed date conformity, and the other 5 states have selective conformity. Each state has its own tax code, and once Congress starts to implement in and start adding and changing, trying to simplify the tax code, this is what usually happens. Next slide. This is my accounting humor for the day. I worked hard on finding this. It took me some time. So I'm excited about this slide. Next slide. Now we'll get into the changes that has been created from the CARES Act. We'll start with the business interest expense deduction limitation. Prior to these changes, business interest expense was deductible in the year in which interest was paid or accrued, and a deduction limitation disallowed all net business interest expense in excess of 30% of the adjusted taxable income of a business. And any amount subjected to the limitation was to be carried forward to future years. Now, after the CARE Act has been put in place, the business interest deduction increases the limit to 50% of adjusted taxable income for 2019 and 2020. The business interest expense deduction limitation does not apply to all certain small businesses whose gross receipts are over 26 million or less. However, this modification does provide some complications on a state level. Before these provisions were enacted, many states already were disjoined entirely from the 30% adjusted taxable income limitation, while other states provided a state modification to adjust the federal interest expense deduction. For example, Virginia allows a 20% state subtraction modification for federal disallowed interest expense. So, depending on the state's conformity method, decoupling or modification adjustments, taxpayers could need to prepare 5 different interest expense deductions amounts for state income tax purposes. And here are those 5. You have the state-specific interest rules, interest expense under the pre-TCJA rules, the TCJA's 30% Section 163J limitation, the CARES Act 50% Section 163J limitation, and the state-specific modifications to the TCJA. Next slide. Now we'll be talking about changes to the net operating loss. There were a few modifications to this as well. Usually an NOL occurs when a business or individual has more allowable tax deductions than taxable income. Prior to the CARES Act, the NOL deduction was limited to 80% of taxable income and could be carried forward indefinitely, but could not be carried back. With the current IRC provisions, taxpayers are now allowed to carry net operating losses arising in taxable years 2019 to through 2020 back to each of the 5 years preceding the year of the loss. Also, the provision suspends the 80% taxable income limitation through 2020. Now, for states, this is a major issue concerning this modification, since most states apply their own NOL calculations and methodologies and may not conform to the limitations prior to the CARES Act. Also, most states already disallow NOL carrybacks, so the benefits from the CARES Act modifications could be limited at a state level. Also, a majority of states apply NOLs on a post-apportionment basis, meaning that if the taxpayer didn't file in a particular state in the loss year and have taxable income in that state later, they have no NOL to use to offset income. Also, watch out for New York and New Jersey, which used to use pre-apportionment NOLs but switched up. Next. Now let's get into the reclassification of qualified improvement property. Improvement property generally includes interior improvements made in buildings that are non-residential real property. Before the CARES Act, the QIP property had a 39-year recovery period, and the property was not eligible for bonus depreciation. Under the CARES Act, the QIP is now depreciated over a 15-year recovery period and now qualifies 100% bonus appreciation if all requirements are met. The problem with this provision is that only a few states automatically conform to federal bonus depreciation provisions. Next slide. So most will require an adjustment to their laws in order to adopt the CARES Act provision. And state conformity to the provision will depend upon its method of conformity, as well as positions on bonus depreciation. For example, states that have rolling conformity to the IRC and conform to Section 168K should automatically adopt the CARES Act provision to include QIP as property eligible for bonus depreciation. And states that have static conformity to the IRC and conform to Section 168K will not automatically incorporate the CARES Act provision and will need to update their conformity dates to adopt the QIP corrections. Next slide. Also, PPP loan forgiveness. I know this has been a very hot topic. A lot of businesses want to know about this. The Paycheck Protection Program was designed to provide a direct incentive for small businesses to keep their workers on the payroll. The PPP provides 100% federally backed loans to help small businesses continue making payroll, rent, mortgage, and utility payments throughout the pandemic. An eligible recipient can receive forgiveness of indebtedness on a loan in an amount equal to the sum of payments made for the expenses mentioned. Next slide. For state tax purposes, each state that implements an income tax has its own revenue code that conforms to some degree to the Internal Revenue Code. In states that do not have rolling conformity, clients may find themselves liable for state taxes even if they would not owe federal taxes for the same situation. And a lot of states hasn't conformed to this because a lot of them are hurting for revenue. So this is still up in the air. So maybe people will have to pay state taxes on this. Next slide. Also, a big question that has been circling around the PP loan forgiveness. Are expenses deductible in 2020 if paid with PPP loan proceeds? According to the IRS, the answer is still no. Taxpayers are not allowed to claim a deduction for any deductible expense if the payment results in forgiveness of a PPP loan because the income associated with the forgiveness is excluded from gross income under the CARES Act. After doing some research on this, there were multiple states that had their opinions on things. Can you go to the next slide? But several states have yet to publish guidance on CARES Act conformity. New York, a rolling conformity state, passed legislation to decouple from certain tax relief provisions of the CARES Act. North Carolina and Georgia, both static conformity states, have passed legislation to conform to the IRC as of March 27, 2020 or later, but also expressly decouple from certain federal tax relief provisions of the CARES Act. So although the CARES Act was designed to, help relieve this economic burden that we've been facing, a lot of states still has not participated in all the modifications that has been done to it. Next slide. So our next word for our survey is time.
Yet another seasoning.
Another season. And if you put them all three of them together, you kind of notice we had salt and pepper time. Pretty clever. Next slide, Amber.
All right.
So that was pretty much a wrap up on state conformity to the CARES Act provisions. If anyone had any questions, feel free to share. If not, we have some more fun Christmas trivia for you guys.
Yeah,
no questions.
I don't see anything. So we're going to move on to trivia. And if you
think
guys
that's-
still have questions, feel free to raise your hand and we'll stop and we'll address them then.
I think that's
Hello?
what they were waiting for, Amber, these trivia questions.
All right, so onwards. And I'll try not to mess it up this time because, last time I shared all the answers.
Okay, awesome. In what state do residents fire Christmas guns every year?
Sorry, I just really like the picture I put on this one. Wow, looks like a lot of Texas.
I see a lot of Texas.
So much Texas.
Okay.
Right,
Awesome.
you guys ready?
Answer time.
Boom.
Sorry, guys, it was not
Texas.
Texas, but Oklahoma. All right. In what state do they have a singing Christmas tree that is made up entirely with carols? A, Delaware, B, Oregon, C, Kansas, D, New York.
And that picture is actually the tree.
I need that tree in my house.
This live music all the time. All right. Answer time?
Yep. Oregon. We got Oregon right. All right, next question. What state hosts a scavenger hunt for locals to get them in the Christmas spirit? A, Georgia, B, Vermont, C, Mississippi, D, Louisiana.
All right.
Answer time?
Yep.
Vermont. Oh, look at Santa. And what state can you actually ski with Santa? A, New York, B, Maine, C, South Dakota, D, Wyoming. Answer, please. D, Wyoming is correct. And I think this is our last question.
Yep.
In what state is a roast over an open fire a long-standing tradition? A, Virginia, B, Hawaii, C, California, D, Texas. I think everybody got this one right.
I had no clue about this one. Is this like a well-known fact? Apparently I need to get to know my states better.
Well, that was today's presentation from Amber and I. We appreciate you all attending. Hopefully you got some great information out of this SALT training. And we thank you guys, and we hope you have a blessed and awesome Christmas.
Definitely. So make sure you guys fill out those surveys, and if you guys run into any questions or have any additional questions, please feel free to contact Mark and myself. And if you want to consult the SALT team, the members on that team is Kendra, Rich Pusovsky, David Harris, and then again, Mark and myself. So thank you all for your time today, and it's been a lot